Stop what you're doing and pay close attention right now, because what's happening in precious metals markets isn't just another price spike you can ignore. It's not just gold hitting $5,350 or silver trading at $140 in Shanghai. Those are the headlines everyone sees. What most people are missing is the structural shift happening underneath those numbers, a shift that's creating a dangerous disconnect between traditional financial markets and hard assets, and that disconnect is flashing a warning signal that has only appeared 4 times in the past 100 years. I'm recording this on Wednesday, January 29th, and it's 8:30 in the morning Eastern Time. Drop a comment telling me what time you're watching this and where you're watching from, because I want to understand how global this audience really is and whether you're seeing these same patterns in your local markets. Before we go deeper, quick context for anyone new here. We have over 1,000 members who get daily exclusive content, early access to every video, and detailed market breakdowns that never hit the public channel. And if you want that level of insight and you want to stay ahead of moves like this instead of reacting after they've already happened, tap the join button below or check the link in the description. It takes 30 seconds and it could change how you see the next 12 months. Now here's what's actually going on. The S&P 500 just crossed 7,000 for the first time in history, driven by a surge in artificial intelligence stocks. Names like ASML, SK Hynix, Nvidia, and AMD are leading the charge. Meanwhile, gold just hit a record high of $5,350 before pulling back slightly to $5,338, lifting the metal's total market capitalization past $35 trillion. Silver is trading at $140 in Shanghai, the highest level on record. On the surface, you might think this is great news across the board. Stocks are making new highs, metals are making new highs, everyone's winning. But that's not how Barry Bannister sees it, and you need to understand why his perspective matters. Problem identification. The disconnect. Bannister is a strategist at Stifel, and he just pointed out something that should make every equity investor sit up and pay attention. There is now a major disconnect between gold and the S&P 500, and according to his analysis, that disconnect is a red flag for equities. The S&P 500's performance relative to gold has broken down in a way that has only happened 4 times in the past 100 years. And here's the part that matters. None of those previous instances ended well for stock market bulls. Not one. Let me give you the specific numbers so you understand the magnitude of this divergence. Gold is up 90% over the past 12 months. 90%. The S&P 500 during that same period has gained 15%. That's a respectable return by normal standards, but it's being absolutely dwarfed by gold's performance. Even after the index climbed to 7,000, Bannister notes that it is now stalling out while gold continues pushing to new highs. That kind of divergence, according to Bannister's analysis of historical cycles, usually means trouble ahead. In past instances where this pattern emerged, stocks stayed range-bound for years, not months, years. And here's where it gets more uncomfortable. Bannister added that even if this turns into a scenario where both gold and stocks keep going up together, it would likely signal a full-scale flight from fiat currencies. And in his words, that has never ended well in history. Think about what that means. The best-case scenario, where both assets rise, still points to a breakdown in confidence in government-issued money. The scenario where stocks stall and gold runs points to a flight to safety that leaves equity investors behind. Neither outcome is bullish for traditional portfolios, so the question becomes, what's actually driving this? Why is gold outperforming stocks by such a massive margin? And why does that matter for your positioning? Root cause analysis, dollar collapse. The answer starts with the United States dollar, because gold's rally is being fueled by investors walking away from the greenback. The dollar index, which tracks the currency against a basket of major peers but notably does not include the Chinese yuan, is down more than 10% over the past year. That's a substantial decline for the world's primary reserve currency. And it just suffered its worst one-day drop since April 2025, triggered by comments from President Trump indicating he wasn't concerned about the currency's decline. When a sitting president says he's comfortable with a weakening dollar, that sends a signal to global markets. It tells investors that the administration views a weaker currency as compatible with its economic objectives, whether that's boosting exports, reducing trade deficits, or maintaining competitive advantage in manufacturing. But it also removes one of the traditional supports for the dollar, the perception that U.S. authorities will defend its value. The euro surged past $1.20 for the first time since June 2021, jumping as much as 1.7% after Trump's comments. The options market is now showing the highest premium for upside euro hedges since March 2020, indicating that traders see potential for further dollar weakness and are positioning accordingly. China's yuan hit a 32-month high, touching 6.9449 against the dollar. Beijing pushed the yuan higher, with its most aggressive daily midpoint adjustment since August, signaling that Chinese authorities are comfortable with currency strength even as it makes their exports more expensive. These aren't small moves. These are structural shifts in how major currencies are trading relative to the dollar, and those shifts have direct implications for commodity prices, equity valuations, and portfolio positioning. Deeper layer. Why this matters for markets. When the dollar weakens, commodities priced in dollars become cheaper for buyers holding other currencies. That creates natural demand. But there's a second dynamic at play that's more important. When confidence in fiat currencies declines, investors seek alternatives. Historically, that meant government bonds, particularly U.S. Treasuries. But right now, investors are sidestepping government bonds in developed markets. There's growing unease around Washington's policy direction, concerns about Federal Reserve independence following the news that the central bank received grand jury subpoenas, and uncertainty about fiscal trajectories. Bonds are falling out of favor as a safe haven. That vacuum is driving demand straight into gold and silver. Rate cut expectations from the Federal Reserve are adding to this dynamic. When a central bank cuts rates, it reduces the opportunity cost of holding non-yielding assets like gold. It also signals concern about economic conditions, which reinforces safe haven demand. Combine rate cut expectations with policy uncertainty under the current administration and recent shifts in U.S. national security strategy, and you create an environment where traditional safe havens aren't behaving like safe havens anymore. That's what Bannister is identifying when he talks about the breakdown in the S&P 500's performance relative to gold. It's not just about gold going up. It's about what that divergence reveals about underlying confidence in the financial system. Now, some people will hear this and think it's just fear-mongering or perma-bear pessimism. I'm skeptical of that dismissal because the data doesn't support it. We're not talking about predictions or theories. We're talking about observable price action, historical precedent, and explicit comments from policymakers. The S&P 500 is at 7,000. Gold is at $5,338. Silver in Shanghai is at $140. The yuan is at a 32-month high. The euro is above 120 for the first time in years. The dollar index is down more than 10%. These are facts, not opinions. What you do with those facts is up to you. But ignoring them because they're uncomfortable doesn't change the reality. Market mechanics. Silver's surge. Let's talk about silver specifically because what's happening in that market deserves its own analysis. Silver in Shanghai is trading at $140, the highest on record. That premium over global prices points to either tight supply in China or a stampede of local buyers driven by industrial demand and yuan strength. China is the world's largest manufacturer of solar panels, electronics, and other products that require silver as a raw material. When the yuan strengthens, it gives Chinese manufacturers more purchasing power for dollar-denominated commodities. That creates genuine industrial buying pressure, not just speculative flows. Silver has been ripping higher for months, and it just clocked its biggest monthly gain since 1979. That reference point is significant because 1979 was during the Hunt brothers' attempt to corner the silver market, one of the most dramatic episodes in commodity market history. For the current monthly gain to exceed all monthly gains since that period tells you this isn't normal market behavior. Silver is up nearly 60% in January alone and more than doubled in value during 2025. The spike is triggering massive trading activity in silver ETFs. The iShares Silver Trust ETF saw $40 billion in turnover on Monday. To put that in perspective, that's neck and neck with State Street's SPDR S&P 500 ETF, one of the world's biggest and most liquid funds. By comparison, Nvidia stock saw $23 billion in turnover, and Tesla came in at $22 billion. Just a few months ago, silver ETF volumes were hovering around $2 billion daily before climbing to $10 billion in December. The acceleration from $2 billion to $10 billion to $40 billion over a short period illustrates exponential growth and interest. That kind of volume surge doesn't happen in a vacuum. It reflects a combination of factors: momentum traders chasing gains, institutions hedging dollar exposure, retail investors seeking inflation protection, and potentially short covering as bearish positions get squeezed. Systemic implications, the two-tier market. Here's where this gets more complex and where most analysis stops short. When you have this kind of divergence between traditional equities and hard assets, you're not just seeing a rotation from one asset class to another. You're seeing the early stages of a two-tier market structure. In a two-tier market, you have assets that benefit from continued confidence in the system, stocks, bonds, fiat-denominated savings, and assets that benefit from declining confidence in the system, gold, silver, real estate, hard commodities. In normal times, these two tiers move somewhat independently based on economic cycles, interest rates, and growth expectations. But in periods of monetary stress or policy uncertainty, they begin to decouple. in ways that create sustained divergence. That's what Bannister is identifying. The historical instances where gold outperformed stocks by this magnitude weren't random. They occurred during periods when systemic confidence was eroding. The 1970s stagflation era, the early 2000s following the dot-com crash, and in the lead-up to the financial crisis. The post-2008 period when central banks were experimenting with unprecedented monetary policy. Each of those periods saw gold significantly outperform equities for extended stretches, and in each case, equities either went sideways for years or experienced significant drawdowns before resuming upward trends. The current setup shares characteristics with those periods. You have elevated valuations in equities concentrated in a narrow set of stocks, primarily technology names tied to artificial intelligence. You have concerns about monetary policy effectiveness. You have geopolitical tensions and trade policy uncertainty. You have a weakening reserve currency, and you have precious metals breaking out to new all-time highs while bonds, the traditional safe haven, are being avoided. Federal Reserve factor. The Federal Reserve's role in this dynamic cannot be overstated. Markets are waiting for the Fed's interest rate decision, expected to be a pause at current levels. But this is Jerome Powell's first press conference since the Fed received grand jury subpoenas, an extraordinary development that raises questions about central bank independence. If the Fed is perceived as compromised or under political pressure, it undermines confidence in monetary policy. That confidence is foundational to the value of fiat currency. When central bank independence is questioned, it creates exactly the kind of environment where investors flee to assets outside the control of monetary authorities. Gold and silver fit that profile perfectly. They can't be printed, they can't be manipulated by interest rate policy, and they have thousands of years of history as stores of value. Additionally, Powell's comments in the Fed's statement will be scrutinized for any signals about future rate cuts, inflation concerns, or economic outlook. If the Fed signals concern about growth or hints at rate cuts ahead, that would support the case for continued gold strength. If the Fed takes a more hawkish stance, emphasizing inflation control and suggesting rates could stay higher for longer, that might provide temporary support for the dollar and pressure for precious metals. But given the broader context of dollar weakness and policy uncertainty, even a hawkish Fed may struggle to reverse these trends. China factor, technology and currency. Another layer worth understanding is China's role in this equation. Reuters reported that China just gave approval for ByteDance, Alibaba, and Tencent to purchase NVIDIA's H200 chips. This regulatory clearance is significant because it shows that despite geopolitical tensions, commercial relationships in the technology sector retain some functionality. The news lifted NVIDIA's stock by about 2%, with AMD and TSMC posting similar gains. But there's a deeper implication here. China approving access to advanced AI chips while simultaneously allowing its currency to strengthen, and while its buyers are driving silver to record premiums in Shanghai, that's not a coincidence. China is positioning itself to participate in the AI infrastructure build-out while also accumulating hard assets and allowing currency appreciation. This is strategic positioning that reflects long-term thinking about global economic power dynamics. The yuan's strength, up 0.7% this month and 4.5% in 2025, is being driven by what's characterized as relentless greenback selling and solid end-of-year demand from China's exporters. When exporters convert dollar revenues into yuan, it creates natural buying pressure for the Chinese currency. But the People's Bank of China is also actively managing this through its daily midpoint fix, signaling that authorities are comfortable with a stronger yuan even though it makes Chinese exports more expensive. Actionable framework, what this means for you. So what does all of this mean for your portfolio and your positioning? First, understand that the disconnect Bannister is highlighting isn't a short-term trading call. It's a structural observation about market dynamics that historically have persisted for years. If you're heavily concentrated in equities, particularly in the technology sector, you need to understand that you're exposed to a potential period of consolidation or range-bound trading, even if we don't see a crash. After 3 consecutive years of double-digit S&P 500 gains, as Bannister noted, the market may simply consolidate. That doesn't mean sell everything. It means recognize the risk and consider whether your portfolio is positioned for a low-return environment in equities. Second, the case for holding some allocation to precious metals has strengthened considerably. Whether that's physical gold and silver, mining stocks, or ETFs, having exposure to assets that benefit from dollar weakness and declining confidence in fiat currencies provides portfolio balance. The key is not to chase. Silver up 60% in a month is not the time to go all in on silver. but systematic accumulation or maintaining existing positions makes sense in this environment. Third, pay attention to liquidity and structure. In volatile markets, the difference between owning a liquid ETF and owning physical metal in a vault you can't access quickly matters. The difference between owning a diversified basket of mining stocks and owning a single high-beta exploration company matters. Structure your holdings to match your actual risk tolerance and liquidity needs. Fourth, monitor the dollar. If the dollar index continues to weaken, it will likely continue to support commodity prices and precious metals. If the dollar stabilizes or reverses, it could create a correction opportunity in metals. The dollar's direction is the key variable right now. Fifth, watch the Fed carefully. Not just the rate decision, but the language around independence, inflation, and policy credibility. Any further erosion of confidence in the Fed's ability to operate independently will accelerate flows into hard assets. Skeptical counterpoint. Now let me offer a counterpoint because I don't believe in one-sided narratives. It's possible that the current divergence is temporary. It's possible that stocks consolidate while gold pulls back, and the two converge without either experiencing a crisis. It's possible that AI-driven earnings growth justifies current equity valuations and drives the S&P 500 higher even as gold moderates. It's possible that the dollar stabilizes once tariff policy uncertainty resolves. These are all possible outcomes. What I'm skeptical of is the idea that the current setup is normal or sustainable without something giving. Either equities need to consolidate, or gold needs to pull back significantly, or we enter the scenario Bannister described where both keep rising but it signals a currency crisis. Of those three outcomes, the currency crisis scenario is the one that concerns me most because it's the hardest to manage and the most disruptive to traditional portfolios. But I also recognize that markets can remain irrational or divergent longer than any of us expect. So the right approach isn't to make all or nothing bets. It's to build a portfolio that can perform across multiple scenarios. Closing. Call to action. Here's what I want you to do right now. First, tell me in the comments whether you're positioned more heavily in equities or in hard assets, and whether you're making any changes based on what we've discussed. Second, tell me what time you're watching this and where you're watching from so I can understand the global reach of this audience. Third, if you found this breakdown valuable and you want access to the deeper daily analysis we do for members, hit the join button below or check the membership link in the description. We produce separate content for premium members that goes even further into market mechanics, positioning strategies, and risk management. Finally, remember that this is educational content based on publicly available market data and analysis. I'm not your financial advisor. I don't know your specific situation, risk tolerance, or goals. Use this as one input into your decision-making process, not as a directive. The market is giving us clear signals right now. A historic disconnect between gold and equities, a weakening dollar, surging precious metals, policy uncertainty. The question isn't whether these signals exist. The question is whether you're paying attention and positioning accordingly. Stay sharp, stay informed, and don't let the noise distract you from the structural shifts happening underneath. I'll see you in the next one.